Good morning, my name is Ron Morris. This is Moving Forward TV, your local real estate and mortgage update.
And I am Dylan Gaston. Thanks so much for joining us today, and thanks so much for sharing the show and moving it on forward and passing it along and emailing it out, because we've been getting a lot of very positive emails and comments and things like that, that this is helping a lot of people. So we really appreciate you sharing this show.
We really enjoy educating everybody out there so we can try to push this recovery along as quickly as possible.
Right. That's what we're trying to do. Okay, that being said, last week we told you we were going to be doing a little mini series teaching about what borrowers should and should not be doing prior to and during their mortgage process. Last week we talked about documentation, the things that they need to gather together. Today we're going to talk about debt to income ratio.
What is debt to income ratio?
And primarily debt. The total income and the total debt that a person has. And today, last week, we talked a little bit about income. It kind of spilled over. And this week, we're going to talk about the debt, what does count and what does not count, that kind of a thing.
Exactly.
Okay, first I wanted to talk about what doesn't count.
Okay.
Because what doesn't count, people are usually very surprised at what does not go into the
few items in particular, people are very surprised at that we don't count that in the debt ratio.
We don't care about your electric bill.
Car insurance.
Right. Life insurance, health insurance, daycare. That's a biggie.
That's the big one right there. Is people are shocked to know that we do not count the daycare into the debt ratio. And I think for a lot of young families out there, that's a big chunk of change, and that's not included in our documentation or in our calculation with the debt to income ratio.
At all. Or loan payments from personal relatives, family members, that kind of thing. None of that counts into your debt to income ratio. What does count into your debt to income ratio?
Well, we're going to break it down into three categories. Number one is loan payments.
Right.
Number two would be credit cards, and number three we're just going to call other now. We'll just get right into loan payments real quick. What is a loan payment? Car loan?
Right.
Student loan? What else would it be?
Personal loans, credit union loans.
Right. Anything that's really on your credit report is what we're kind of looking at there.
Used to be 401k loans.
Or on the pay stub. A lot of times people, just because they don't write that check out every month and they have a auto deduct on their pay stub for some type of loan, not a 401k loan, I might add, then we have to count that in the debt to income ratio.
And sometimes people don't remember to tell us that part because they think, oh, it comes right out of my paycheck, so it doesn't count. It counts. And
another thing we want to throw out there as well, if any installment loans like we're talking about, if there are 10 payments or less remaining, we don't have to count that.
Right.
And that's a big thing. Yeah.
If your car's almost paid off,
don't go buy a new one.
Car, regardless if it's a lower payment, because if it has less than 10 payments, we're not counting it. So don't do that.
And to play along those lines as well, in reference to the a lease payment, a lot of people lease autos these days. Regardless of how many payments are remaining on that auto lease, we have to count that payment. So again, don't go out and buy a new one, but we are counting that lease payment regardless of the amount of payments that remain.
Even if you only have a month left, because you got to do something with that vehicle. So they count no matter what. Okay, the next category is credit cards.
People have credit cards?
Everybody has credit cards out there. What we're looking at in the credit cards is your minimum monthly payment.
Not necessarily what you're sending in every month.
Right. You might be, chalking down $100, $200 a month trying to get it down, which is great, but all we have to count against you is your minimum monthly payment.
And just as a reminder, that's a good reason not to throw that statement away too, because that can help prove to an underwriter what your minimum payment is.
That's right.
The credit report might not reflect what your minimum is if you're sending more than the minimum in. Keep that statement until you're done with this.
See last week's show, documentation. Don't throw anything out.
And the next and last category would be what we call other, primarily child support and alimony. And let's talk about alimony is alimony. Child support, let's talk about that. Most of the time, depending on how the divorce decree is put together, child support will go till age 18. Sometimes it goes beyond that, depending on the child goes to college or not, and how it's drawn up to begin with. Let's just go on the assumption it's to 18. If that child is 17 and a half, hence there's less than 10 payments remaining, we don't have to count that. Now, what are we going to need to prove that child's 17 and a half?
A birth certificate?
Exactly. So be prepared to furnish a copy of a birth certificate for however many children we're talking about, so we can show that there are less than 10 payments remaining should that apply. And I think you want to talk about the income side of that too.
I was just going to say, that's on the debt side. Just keep in mind, on the they always look at things from the worst perspective if you think about it. So just keep that in mind. On the debt side, we have to count that child support payment until that child is 17 and 2 months old, we have to count that payment. However, on the income side, the child can't be older than 15 because it has to have at least 3 years remaining in order for me to include it in their income side.
And again, that birth certificate is going to document for us that if the child's 14, it goes to 18, then I'm counting that $500 a month or whatever it happens to be, income to help offset for your for qualification purposes.
And now, keeping along that, like Ron said, until the child's 18 years old. Sometimes the divorce decree or child support agreement states that until the child is 18 or secondary school, college. Is now, we have no idea, the underwriter has no idea of knowing if your child who is 17 and a half years old is going to college
going or not.
So they're going to count it no matter what, even if, you know, the child is failing. I don't want to say that. but even if the child maybe not is doing that great or maybe not be going to college, if it says it in the divorce decree, they are going to count it because they have no way of knowing.
Right, absolutely.
And just as a quick note, you know, about loans, co-signing, if you have co-signed a loan for someone, that does count, unless we can prove 12 months canceled checks that you're not making that payment, car loan or whatever it is, that the other person is. And the other person has to be making that payment.
A minimum of 12 months.
Right.
We need 12 months canceled checks.
Checking account that you are not on. So if it's a joint account, you know, you and mom and dad or something like that, if you're on that account, then I still have to count it against you. But if that other person has a separate checking account all by themselves and they make the payments out of that account, then we don't have to count it against you.
And something I think both of us have seen as well, and I hear this a lot of times when it's a parent co-signing for a child, the child gives me cash, I paid it out of my account. Well, guess what? We're counting the payment against you. Period, end of story.
Right.
So anyway, let's kind of move on a little bit. We want to just kind of finish the show real quick on some basic do's and don'ts of what to do and what not to do on kind of an overall view. First do is please get pre-approved by a mortgage professional before you start looking at homes. You know,
the world has changed so much, and you really have
to. In our world in particular.
Yes, you really have to get pre-approved these days.
And when you're writing when you are making an offer, I just had this happen to me recently. You always have to make an earnest money check. So you write out $1,000, $2,000, whatever it happens to be, so you can present an offer. Make sure you do it out of your account. I had one right now. We always have to get a copy of that check. I mean, that's standard procedure. The one I just got a copy of it from first-time home buyers, and they gave me a copy of the check, and guess what? The check was from mom. That's going to be a problem. Can we overcome it? Probably. We'll probably have to address it with the underwriter, but don't put yourself in that situation. Make sure you're writing that earnest money check from your own account, not somebody else's.
And I had one similar where they actually had given cash or something to the realtor, and the realtor took it and converted it into a bank check.
A cashier's check.
A cashier's check. But the cashier's check was not from the borrower's account.
You mean it was from the realtor?
Realtor's name was in the memo line. Well, that makes it look like the realtor is giving them the down payment.
Which wasn't the case, but when you look at that paper trail from an underwriter,
have it all done all over again.
You know, that's a problem.
That's what we're going to have to do, right?
Exactly. Make sure you're making a copy of everything that you're doing as far as your finances are concerned. Don't throw away your pay stubs. I think you were going to say that one. Start collecting your tax returns, your bank statements, things like that. We're going to ask for them, so just get prepared for that.
If you're getting ready to move, don't tuck that stuff in storage. Keep a file with all that stuff because we're going to need it. On to the don't side. Don't throw away your pay stubs. Don't throw away your bank statements. Print them out, keep them, like we said, in a file or something like that. Don't open up any new credit, and don't use any more credit.
Please.
I don't mind you, like, you know, getting gas in your car, something like that with your credit cards. That's good. It shows activity, but don't go making any large purchases.
Don't go to Rooms to Go. You're going to furnish your new home before we're done with this. No. And I know we've heard, well, I don't have to make any payments for 12 months. Well, guess what? We're counting that payment in your debt ratio. On a tight income to debt ratio, that could be a problem. Could make the difference of getting a home or not.
Right.
Don't use credit.
Know, and we're going to get into credit probably in the next week or so. Is going to be one of the things we're talking about. But what a lot of people do is they go right before closing. They go to Lowe's or Home Depot or something, and we need a lawnmower, and we need. You know what? That's going to kill things because they are repulling credit.
Usually a day before you close.
Or closing day or something, and it could kill the whole thing. So just be real careful with that. Don't. The last don't I have is don't make any large deposits. Don't move any money without talking to us first. It's not that you can't, but talk to us first because we have to see every dollar in the transaction.
Right.
So if all of a sudden $5,000 pops in your checking account, big red flags go up, and they need to see where it came from. You might have just transferred it from your 401k or whatever it is. We need a paper trail of the whole thing. So don't move any money around without talking to us first.
And playing along those lines as well, a lot of people are selling items, cars, motorcycles, boats, whatever,
you know, a boat.
maybe to come up with a down payment and closing cost. We need a paper trail on that. We need a proof that you sold it, proof that you owned it, and a copy of the check that you sold it, and a copy of that deposit going into your account.
Right.
So it's paper trail, and so that's
again,
a
all
thing
of
to
this can be overcome, but talk to us first so that we can guide you through real easy, the step-by-step and what we need to do. On to our movie challenge. Last week's winner was Keith Rossignol. And Keith, I apologize if I am butchering your name. From Charles Ruttenberg Realty, who correctly identified
Pulp Fiction. Great movie. We got a lot of Charles Ruttenberg realtors winning a lot of these things.
All right. So, maybe we should have some sort of a contest with that. Anyway, remember, email us with the correct answer to our movie challenge, and you could win a gift card of some
your
sort.
choice. So and here's this week's challenge.
Right here.
What's wrong, McFly? Chicken?
That's our show this week. We really appreciate all the input that we're getting. Please, by all means, blog us down below. We have that social
Twitter,
networking
Facebook.
Stuff going on.
We're on all of ours. Please put us on yours, too. If you like the show, send it on out, forward it on. This is a great show. Another
it's a great one for some first-time buyers in particular, for the realtor partners out there. If you have any buyers that you're working with and maybe they're a little confused about what's going on, this is a great show to forward to them. We also have some standalone videos somewhere over here. There's a video tab, short 1 or 2 minute little videos, primarily for first-time buyers as well. So feel free to share that and call us, email us. We'd love to hear from you.
Visit our sponsors as well. Our sponsors are the ones who keep us coming to you each week, and we thank them so much, and they are great people, so visit them as well. That's our show. Thanks so much for joining us. We are
moving forward. We'll see everybody next week.
Thanks. Bye-bye.
Wake me when the show starts.
It's already been on a while.
Wake me when it's over.